All right, picture this. One day, gold hits an absolutely unbelievable all-time high. And then, literally the next day, it suffers one of its worst crashes in a decade. I mean, it was a dizzying 24 hours that left investors completely stunned. So what gives? Was this just a random panic, or is it a signal of something way deeper? Let's dig in and figure out what's really going on with gold.
Okay, so first let's set the scene here. On January 29th, 2026, gold wasn't just doing well, it was absolutely shattering records. You had central banks buying it up, all this geopolitical risk, and it just surged to a peak of nearly $5,600 an ounce. And this wasn't out of nowhere, it capped a massive rally. I'm talking prices were already up 14% for the year, and that was on top of an incredible 64% gain from the year before. Just wild.
And then, boom, the floor just fell out. We're talking just 24 hours after that historic high, gold plunged nearly 10%. The sheer speed of this drop is staggering. This was one of the biggest single-day declines in over a decade, wiping out a huge chunk of all those recent gains in just one session. Gone.
So, right here, this is the central mystery we're going to solve today. You've got a record high immediately followed by a historic crash. What on earth could trigger that kind of whiplash in the market? Let's start breaking down the evidence.
All right, first up, let's get the timeline straight, because this volatility wasn't just a two-day thing. It was a total roller coaster ride, and it tells us a lot about how the market thinks.
So take a look at this. After closing out 2025 strong, gold just goes on an absolute tear, right? It hits that record high on January 29th, then, bam, the plunge on the 30th. But, and this is key, look what happens next. By February 4th, it's already staging a pretty solid recovery, climbing back toward 4,900. So this wasn't some slow bleed. It was a violent shock followed by a surprisingly quick bounce back.
So the big question is, what happened on January 30th? Well, as it turns out, the market's panic wasn't random at all. Nope. It was a reaction to a single major political headline, which became the prime suspect in our little investigation. And here it is. This is the headline that sent shockwaves through the market. President Trump's nomination of Kevin Warsh to be the next chair of the Federal Reserve. Now, you got to understand, for traders, a new Fed chair is a massive deal, and they reacted instantly. And the immediate impact was just severe. This quote from Southeast AgNet really puts it in perspective. This wasn't just some minor dip. We're talking gold's worst day in over a decade, and silver's worst since 1980. The market wasn't just spooked. It was in a full-blown panic over this one piece of news. But, and this is where our story takes a really interesting turn. The market's knee-jerk reaction was crystal clear, right? But was it the right one? Is it possible the traders just panicked first and decided to ask questions later? Okay, so the reason everyone freaked out is because this guy, Warsh, he has a reputation for being a hawk. And simply put, a hawk is a policymaker who likes to see higher interest rates to keep inflation in check. Now, for something like gold, which doesn't pay you any interest, the idea of higher rates elsewhere makes it look a lot less attractive. So the market's thinking was simple. Warsh equals hawk, hawk equals high rates equals bad for gold. Sell, sell, sell. But this right here is the crucial point. The market feared a classic hawk who would just start jacking up interest rates. But Warsh's actual view, it's way more nuanced. See, he's less focused on interest rates themselves and way more concerned about the Fed's gigantic balance sheet. The trillions of dollars the Fed basically printed after the financial crises. He believes that that's where real inflation comes from creating too much money. And ironically, that's a view that could actually be very, very good for gold in the long run. And yeah, the analysts jumped on this right away. They started arguing that a Fed focused on long-term discipline instead of just trying to manage the market day to day would actually create a more stable environment where real assets like gold can thrive. So get this, the very thing the market panicked about might have actually been good news in disguise. And this brings us to a really key theme from Wells Fargo's 2026 outlook, which is this idea of trend lines over headlines. The Warsh nomination, that was the headline, and it caused a huge panic. But the underlying economic trend lines, well, they were telling a completely different story. And here are those trend lines in black and white. While everyone was hitting the panic button, Wells Fargo is actually upgrading its economic forecasts. They raised their outlook for both U.S. and global growth. They lower their unemployment forecast. And they pointed to these really powerful drivers, like resilient consumer spending, and the massive AI investment boom. The fundamental picture was just strong.
And it wasn't just about GDP either. Just look at the consensus forecast for copper. Now, copper is a key industrial metal, right? They often call it Dr. Copper because it's such a great barometer for economic health. And all the major players, we're talking the World Bank, Goldman Sachs, JPMorgan, they were all incredibly bullish on it. They were pointing to supply squeezes and huge demand from things like renewable energy and AI. This signals a really broad, fundamental strength in the exact kind of real assets that often move in step with gold.
Okay, so let's put all the pieces together. What does all of this mean for the 2026 outlook? And, more importantly, how does it finally solve the mystery of that crazy crash?
Well, the underlying bull case for gold is still incredibly strong. You've got sustained buying from central banks, you've got ongoing geopolitical risks, you have monetary policy that's shifting, and you have this massive long-term trend of de-dollarization, where countries are slowly moving away from relying only on the US dollar. These are powerful, deep-seated forces that don't just disappear because of one scary headline.
And here is the big payoff. In the middle of all that chaos and volatility, Wells Fargo didn't panic. Not at all. They looked at the trend lines, not the headlines, and they issued a massive upgrade to their gold target, raising it by nearly 35% for the end of 2026. Wow.
So, the resolution to our mystery is this. The crash was just a flash of panic. It was a classic case of the market completely misreading a headline. The real, durable story, the trend line, is that strong, fundamental, and economic backdrop that continues to support gold and other commodities.
Which leaves us with one final thought. This whole episode is just a perfect case study in how markets behave, isn't it? So the next time you see a market going into a full-blown panic, it's worth asking yourself a simple question. Am I reacting to the headline, or am I focused on the trend line?